Okay, let's unpack this. I have a question for you to start things off. When you hear the word mullet, what's the first thing that pops into your head?
Oh, man. Billy Ray Cyrus, 1992. Achy breaky heart. Business in the front, party in the back. A total classic.
Exactly. A classic. Now, I want you to hold that image in your mind, and now, just delete it completely. Because the kids today, Gen Z, they've reinvented it. They're calling it the 401k mullet.
I've seen this floating around TikTok. It is definitely not the Billy Ray Cyrus look.
No, it is not. It's still technically business in the front, party in the back, but the party is, how do I put this? It's heavily regulated.
Right.
It's groomed, it's contained, it's responsible. And you pair that specific haircut with, say, a beige quarter-zip sweater, and you have the defining look of early 2026.
It sounds so funny when you describe it like that, but it's actually a really profound economic signal. We're looking at a generation that is trying to physically embody compound interest.
And that is exactly where we're starting today. It is Super Bowl Sunday, February 8, 2026. The Seahawks and the Patriots are warming up as we speak, but we are not here to break down the zone defense.
No, we're here to look at the world that is watching the game.
Because whether it's this haircut or the ads you're going to see at halftime or the fact that the U.S. government is suddenly buying stocks, everything is pointing to one huge theme.
Anxiety.
It feels like we've moved past FOMO, fear of missing out, and into a totally new era, maybe phobie, fear of being empty-handed.
FOBE. I like that. It's this desperate search for stability. We're seeing a fundamental shift where, boring financial safety has become the ultimate luxury good.
Stability is the new status symbol.
Exactly.
So here's the mission for this deep dive. We're going to connect the dots between Gen Z's obsession with retirement accounts, big tech burning cash like it's kindling, and why the U.S. government has decided to become a venture capitalist.
It's a strange time to be alive. Let's start with the fashion, though, the quarter zips.
Right, the quarter zip movement. This whole thing kicked off with a creator named Jason Gyamfi on TikTok. He posted this one video, and it just racked up 31 million views.
Wow.
And his whole point was basically, wearing a quarter-zip sweater signals that you're ready for a job, you're safe, you're professional, you are not a liability.
It's the ultimate anti-fashion statement. It's blending in as a survival tactic, and it pairs perfectly with that 401k mullet idea.
Yeah.
We have a quote in the research from Tamai Sardari, a professor at NYU, which I thought was just brilliant.
What'd she say?
She said the 401k used to be the most boring thing on earth, but now it's unattainable and therefore sexy.
That phrase really sticks with me. Unattainable and therefore sexy.
It makes stability sound harder to get than like a Birkin bag.
Exactly. And you see it in pop culture. The rapper T-Pain posts on Instagram, and the caption is just 401k and a quarter zip. It got over 122,000 likes.
That is a massive vibe shift.
It really is. I mean, think back to, 2021, 2022. The cool look was the college dropout crypto billionaire,
Yeah.
right? Yeah, the hoodie, the messy hair, the whole move fast and break things energy.
Everyone wanted to be the disruptor, but now, young people are looking at a softening labor market. They see AI taking those entry-level jobs, coding, copywriting, the stuff that used to be a stepping stone.
They don't want to look like a risk taker anymore.
Because a risk taker looks like someone who gets laid off. They want to look like they have a steady paycheck.
So the quarter zip is armor.
It's camouflage for a white-collar recession.
But is this just an aesthetic? Is it just people playing dress up? Or are they actually, putting their money where your haircut is?
Oh, they're absolutely putting money down. The data from Fidelity is just striking. Gen Z is saving earlier and at way higher rates than millennials or Gen X did at the same age.
How much higher?
We're seeing average 401k balances for them hitting record highs. We're talking near $144,400 at the end of 2025.
Wait, $144,000 for 20-something. That is a lot of cash to have locked away.
It's massive. And it's driven by fear. When you think Social Security won't be there, and you think AI might take your job at 35, you save aggressively at 22. You build a fortress.
And there was that NerdWallet survey, too. This one made me laugh, but it's also kind of telling. 15% of adults said they wouldn't even date someone who didn't have a retirement account.
Nothing says romance like a diversified portfolio, right? But it makes sense. If the world feels chaotic, you want a partner who represents order, not volatility.
Speaking of order, or the disruption of it, this anxiety is bleeding into education in a huge way. We're seeing the rise of what people are calling uncollege.
This is the logical next step. If the four-year degree doesn't guarantee that quarter-zip safety anymore, well, people start buying it. It's a simple consumer reaction.
And the numbers back it up.
Yeah, enrollment in community colleges is up 3%, while private four-year nonprofits are down almost 1.6%.
It's a value judgment.
Mm.
But we can't ignore the policy driver here. We have to talk about President Trump's higher education bill that passed back in July of 2025. That changed the math completely.
The big, beautiful bill, as it was called, the headline number there is the borrowing limit. Federal student loans are now capped at $257,500 for a lifetime.
Which sounds like a lot of money to most people. But for a medical degree or some high-end private school, you hit that ceiling incredibly fast.
You do. And what that cap does is force a really hard conversation about ROI, return on investment, at the dinner table. You can't just borrow endlessly for a degree in a field that pays, say, $40,000 a year.
The math just doesn't work anymore.
The government has shut off the infinite money tap.
So where are they going instead? If not the liberal arts college, where?
Vocational training, certificates, 2-year degrees. And starting in the middle of this year, the workforce Pell Grants kick in. This is a big deal. You can use federal grant money for these short-term job training programs, not just for traditional degrees.
So the government is explicitly incentivizing a shift away from the liberal arts and toward the skilled trades.
Because that's where the shortage is, and that's where the safety is. We're in a white-collar recession. AI is eating the junior analyst jobs, the paralegal work. Meanwhile, you can go into nursing or specialized manufacturing and make over $100,000 a year.
It's a pragmatic pivot. The uncollege movement is basically saying, I'd rather have dirty hands and a full bank account than a clean desk and a layoff notice.
Precisely. So you have individuals, Gen Z, locking down their spending, saving every penny, avoiding debt. They're in austerity mode.
But then you look at the companies they work for, and it is the complete opposite. Big tech is spending money like they're trying to burn it before it expires.
This is the great paradox of the 2026 economy. Personal austerity meets corporate excess. We have to talk about CapEx, capital expenditure. This is the money companies spend on physical stuff, buildings, servers, tech.
And the numbers for 2026 are just astronomical.
The 4 hyperscalers, Amazon, Microsoft, Google, Meta, are projected to spend nearly $700 billion this year, just this year, on AI infrastructure.
$700 billion. Just to put that in perspective, that is larger than the entire GDP of Switzerland. It's an unimaginable amount of money.
It's historic. They're buying up chips, building these huge data centers. But here's the problem. The cost is so high that it's destroying their free cash flow.
Okay, for anyone listening who isn't a CFO, let's define free cash flow here. Why does it matter so much?
It's simple, really. It's the cash a company has left after it pays all its bills and buys the stuff it needs to keep growing. It's the real profit. It's the money you can use to pay dividends or buy back stock.
It's a sign of a healthy business.
The ultimate sign. And right now, it's evaporating. Amazon is projected to have negative free cash flow in 2026, a deficit of somewhere between $17 and $28 billion.
Amazon. The company is famous for being an efficiency machine, the one that counts every paperclip.
Running a deficit, yes. Amazon stock even dropped about 6% recently when this forecast came out. And Meta's in the same boat. Their free cash flow could drop almost 90%.
It feels like a prisoner's dilemma.
That is exactly what it is. If Google spends $100 billion on AI and Microsoft doesn't, Microsoft risks becoming irrelevant in 5 years. So they all have to spend the money, even if they don't know if the payoff is there yet.
So they're just burning the furniture to heat the house because they're terrified of freezing to death.
And nowhere is that gamble more visible than where we started the show. The Super Bowl.
Super Bowl 60. If you want to see who has money to burn, you watch the commercials.
The ad sold out at an average of $8 million for a 30-second spot, and the lineup is the perfect mirror of this AI arms race we just described.
It's the AI Super Bowl. I was looking at the roster. You have Anthropic running an ad that apparently takes a shot at OpenAI.
And OpenAI is firing right back with their own spot. Then you have Google pushing Gemini, Amazon has a spot for Alexa Plus with Chris Hemsworth, and Meta's showing off the Ray-Ban glasses. It's just wall-to-wall AI.
Even the smaller companies are buying in. There's a company, Artlist.io, and they ran an ad that was entirely generated by AI, cost them a few $1,000s to make.
Which is ironic because they paid millions to air it. But the real story isn't who is there, it's who isn't.
The automakers.
Correct. If you go back to 2012, automakers were like 40% of the Super Bowl ad minutes. It was basically a car show with a football game in the middle.
And this year?
7%.
That is a total collapse.
Only GM, Toyota, and Volkswagen showed up. The rest are sitting it out.
Why? What's the thinking there?
It's just uncertainty. The auto industry is getting hammered by tariffs. They're pulling back on EV production. Interest rates are still hurting loans. They just don't have the confidence to drop $8 million on 30 seconds of airtime.
But you know who does have confidence? Mayonnaise.
Unilever, they are the outlier here. They're running 3 ads Dove, Hellmann's Mayo, and Liquid IV.
It's a defensive bet. When the economy gets weird, people might stop buying new electric SUVs, but they're still going to make sandwiches.
It brings us right back to that theme of stability. Mayonnaise is stable. AI is risky. The Super Bowl has both.
Now, here's where the Super Bowl gets really meta. You can now bet on the commercials themselves.
The prediction markets. This is fascinating. Platforms like Kalshi and Polymarket are letting people trade contracts on things like, will Sydney Sweeney appear in an ad?
But wait a second. Thousands of people already know the answers to these questions. Ad agencies, network execs, the actors.
It's a massive insider trading risk. The CFTC, the regulators, are just tearing their hair out over this. If you're a junior copywriter at an agency and you know your client bought a spot, you can go bet $5,000 on yes. It's basically free money.
And illegal, I'm assuming.
Technically, yes.
Right.
Practically, it is very hard to police. The markets are moving way faster than the regulators.
It's the Wild West of finance meeting the most corporate event in America.
Captures the chaos of 2026 perfectly.
Speaking of the Wild West and massive wealth, we have to check in on the man who might become the world's first trillionaire, Elon Musk.
The consolidation of the Musk empire is fully underway. He's merged SpaceX with xAI, his artificial intelligence company.
And the valuation of that combined company is just, it's hard to wrap your head around it. $1.25 trillion.
For a private company, that puts Musk's personal net worth at around $845 billion. He's the first person to cross the $800 billion mark.
So he's essentially lapping the field at this point.
He is. The math says if SpaceX and xAI hit a valuation of $1.6 trillion, he crosses the line to become a trillionaire.
But there's a catch in that math, isn't there? This assumes Tesla's stock doesn't crash.
Right, and Tesla is actually down 9% this year. This is the crucial shift people need to understand. Musk's wealth is migrating. It's moving away from consumer goods cars and moving toward infrastructure, rockets and AI.
He calls them orbital data centers.
Exactly. He's pivoting from selling things to people to selling infrastructure to the future. It's a hedge. Just like the kid with the quarter zip, Musk is hedging against a changing world.
Which brings us to the biggest hedge of all. We've talked about individual saving, companies spending.
Yeah.
Now let's talk about the government. Because the Trump administration is doing something we haven't really seen before in peacetime.
The Gov portfolio. The administration is taking direct equity stakes in private companies.
This isn't a bailout, though, like in 2008. This is different.
No, this is strategic. We're talking about the government owning pieces of Intel, U.S. Steel, MP Materials.
So why? Why does Uncle Sam need to be a shareholder in a steel company?
The argument is strategic independence. The administration is saying, look, we're giving you billions in subsidies to build chips or mine minerals so we aren't dependent on China. In exchange, the taxpayer deserves a slice of the upside.
On paper, I can see the appeal. If the company wins, the country wins.
That's the pitch. But the risk is what economists call capital misallocation. When the government starts picking winners and losers, markets get distorted.
And conflicts of interest must be everywhere.
Everywhere. If the government owns 10% of U.S. Steel, does U.S. Steel get favorable regulatory treatment? Does the company start making decisions to please Washington instead of its shareholders?
It blurs the line between public policy and private profit.
It creates a very gray area. And speaking of gray areas and the people managing them, we have to touch on the fallout at the Commerce Department, because the man in charge of this Gov portfolio, Commerce Secretary Howard Lutnick, is having a very bad week.
The Epstein files.
The Epstein files.
Yeah.
The latest release has been a slow-motion car crash for him. The New York Times reported he interacted regularly with Jeffrey Epstein long after he claimed he'd cut ties back in 2005.
And this has real political teeth, right?
It does. You have Republican Representative Thomas Massey calling for Lutnick's resignation. This creates instability in the very department that is supposed to be managing all this.
It's even spilling over internationally.
Yeah, in the UK, Keir Starmer's chief of staff resigned over the appointment of Peter Mandelson, who was also named in the files.
It just shows how fragile these structures are. You have these grand economic plans, but they rely on individuals.
Yeah.
And if those individuals have skeletons in the closet, the whole thing can wobble.
It adds another layer of unpredictability. And when systems are volatile, institutions crack.
Speaking of institutions cracking, the media landscape is shaking too. We just got news that Washington Post publisher Will Levis is out.
Right after mass layoffs where they cut a third of the staff, the Post has been bleeding subscribers and money for a while.
It feels like another institution that just couldn't pivot fast enough.
Or didn't hedge properly. They were stuck in the old model while the world moved on.
So let's zoom out. We've covered haircuts, AI spending, government stocks, and Super Bowl ads. What's the through line here? What's the story of February 8, 2026?
The theme of 2026 is the Great Hedge.
Explain that.
Everyone, from the 22-year-old on TikTok to the President of the United States, is trying to buy insurance against a future they don't understand.
Okay, so Gen Z.
They're hedging against a jobless future by wearing quarter zips, acting boring, and hoarding cash in their 401ks. They are making themselves very small targets.
And big tech.
They're hedging against irrelevance by spending $700 billion on AI, hoping they own the next big platform, even if it bankrupts them in the short term.
And the government.
Hedging against geopolitical risk by buying equity in the companies that build the critical stuff. They are essentially nationalizing stability.
Everyone is building a fortress.
Everyone is trying to make themselves too essential to fail.
Which leads to a question I want to leave everyone with. If stability is the ultimate goal, if we're all just trying to be safe, what happens to risk?
Real risk. Not corporate spending risk, but the kind of risk that leads to unexpected breakthroughs.
Right. If Gen Z is too afraid to be the college dropout founder because they need a 401k match,
Yeah.
and if big tech is just using brute force money to dominate, where does the next weird, unexpected thing come from?
Are we entering an era where we're too afraid to fail? Because usually innovation requires failure. If you hedge the failure out of the system, you might just hedge the innovation out too.
Is this calculated caution the only way to survive? Or is it a trap?
That is the question.
Something to chew on while you watch the game tonight.
And hey, enjoy the commercials, especially the ones made by humans.
Or the ones that betting markets predicted.
That's it for this deep dive. We'll see you on the other side.
Take care.